I guess we can get started then. Um, Amanda, so my first question for you would be, how do you think the Midwest startup and VC ecosystem has sort of evolved over the past decade?
So I just wanted to give a little quick introduction of myself, just to kind of put some of my, I guess, opinions and feedback in perspective. I am an associate at M25, and I'm also a full-time student at University of Chicago Booth. Background in engineering and healthcare and consumer goods, and also have a company that I founded 7 years ago that was a concert event company. So I'm not as experienced as some of the other people in this panel on VC. I haven't been working kind of in VC for the last 10 years or anything, but I have seen some just interesting data lately from Drive Capital. They had a tweet recently come up just showing that I think it was about 7 years ago, there was $2.6 billion of VC money in the Midwest, and now we're at $8.4 billion. But in both of those cases, there's still 6.6% of the total money, being invested nationwide. So it's definitely, growing, but it seems like it's still growing by, the same portion of kind of nationwide. The money definitely funds getting larger and everything as well.
Definitely, that's really interesting. Guy, bouncing that idea off of you, so how do you think the Midwest sort of startup and VC ecosystem has evolved compared to like the East Coast or Silicon Valley, for example?
Yeah, it's a great question. I mean, it's a little bit hard for me to compare the East Coast and the West Coast since I have not been there. I mean, physically I've been there, but I have not been working there for the last decade. What I can say for sure is that the ecosystem in the Midwest and Chicago in particular has evolved significantly over the last 10 years. When we started our fund, there were maybe 6 active funds in the Midwest, maybe 6 or 7, but probably 3 of them were really national investors who just happened to be based here. So there were really only about 3 or 4 that were focused on startups here. And now there's probably something on the order of 15, maybe even 20, depending on how you count. And with quite a lot more assets under management, probably 5 to almost 10x as much. So that's a real significant improvement in terms of the supply of capital for entrepreneurs. And then, of course, at the same time, there's been a massive growth in entrepreneurs in companies getting.
Understood. That definitely makes sense. George, we'd love to know your thoughts on this as well.
Yeah, sure. Thanks, Harshid. So just for a quick background, actually, I haven't been in the U.S. that. I actually came to Chicago January of 2020, so I've been here for a little over a year. Very interesting to be in a city like Chicago covering the Midwest. And I basically head up the office for the TSX as well as the TSX Venture Exchange, primarily helping U.S. companies raise public cap. But just to echo what I was saying, I think some of the trends that we're seeing in terms of like what's happening in the Midwest is, one, I think you're starting to see more investors that are outside of the Midwest take notice of Midwest-based startups. I think you're seeing more of that happen a bit more recently. So I think our ecosystem is starting to be taken a bit more seriously. I think the other kind of trend, given the whole virtual environment, I think it was happening pre-COVID as well, but you're actually starting to see a lot of the HQs getting set up in the Midwest as well. So away from the coast, away from Cali, away from NYC, which is actually really nice. And I actually think you're starting to see a bit of a diversification in terms of the sectors that are being funded. Predominantly, it's been a lot of software. I think now we're getting more recognition for kind of nascent or emerging trends, like whether it's esports, whether it's blockchain, whether it's on the drone side. There's so many of these like interesting or exciting pockets coming up that are, aside from your just traditional software company that gets all the major headlines from TechCrunch. So I think that's something to be excited about, and I definitely can dig a bit more into this as well.
Definitely. I mean, that seems really interesting and sort of brings us to the next question that we have. So Sergio, I guess the next question for you would be like, what sort of sectors do you think the Midwest region has been sort of the most bullish on, or what sort of sectors do the investors in the Midwest region have been really attracted by recently?
That's a great question. I dropped a link in the chat for the session on some research we did at Rebel One on specifically on Chicago and the surrounding region. I think it comparatively, you look at the different ecosystems, and What I enjoy about Chicago and the Midwest is the valuations seem to me a little bit more rational and down to earth. Where on the coast some of these startups are, I say, in a team in a dream phase and get a lot of capital because there's a lot of capital there. But in terms of industry of focus, historically, if you take a step back, you look at food tech, think of the ecosystems like the early stage food. Mars company is also an area. You think of GitHub, Grubhub, and some of those startups that started in the region. The region is heavy in real estate investment, which I think can and will yield more like real estate over. And you have healthcare investments. I mean, Chicago is the third largest ecosystem by GDP across the U.S. and largest by venture dollars. So you can see that there's a gap there, and I think part of it may be, people catching up to the opportunity here, and then also it might be culture in the region. I think with more larger tech companies coming to the West Loop area and surrounding areas, and then people leaving those companies eventually to start their own, you'll see a change in culture, and that's, I guess, my hypothesis. But I'm sure others have, may have differing thoughts.
No, that's definitely, thanks a lot, Sergio. That's really interesting. Guy, what would your thoughts be on that in terms of what sort of sectors have been really attractive for investors in the Midwest?
We've been very fortunate with logistics, software and technology in particular. No big surprise, the Midwest is at the center of the country in so many ways, and so both figuratively and literally. And we have really three investments in the region. One's actually in Atlanta, but all in logistics that have done really, really well. A company called Fork Heights, which does visibility tracking of where truckloads are. One called ShipBob, which is a third-party logistics solution for e-commerce, which has had a phenomenal year, as you can imagine. And then a company called RoadSync, which does payments in the space. The other area that the Midwest is big on is healthcare. There's some really important nexus locations like Cleveland, of course, for Cleveland Clinic, and Mayo Clinic up in Rochester, Minnesota. And so that's another place that has been very strong.
Definitely makes sense. Amanda, what would your sort of concluding thoughts be on what Guy and Sergio have mentioned today?
Yeah, I think I would definitely echo a lot of the thoughts as far as just the healthcare space being really promising. We've definitely had a lot of interesting health tech investments that we've made on our end. And also to just, in general, while it's not as, big in the Midwest compared to, looking at like the East Coast and everything and the West Coast, we've had a lot of good luck with our team and, investing in a lot of different SaaS companies.
Understood. Well, so sort of bouncing off of that, there's been a lot of, really exciting trends that we can see in technology that a lot of these startups have sort of been leveraging and making use of to build the products that they've successfully been able to build. So George, what do you think have been some of the most exciting trends in technology that startups have started successfully leveraging?
Yeah, one of the recent ones I've been seeing actually is around the no-code AI space. I think that, and I think it's not maybe a new subsector to say the least, but I think you're seeing more advancement on that. So a classic example of an Ottawa-based company that started, which was Shopify, as an e-commerce giant now that's dual listed TSX NYSE. I think, they kind of were one of the big proponents of that, right? Where you can basically create your own site without massive, coding experience as an example. So seeing a lot of that. I think recently as well, specifically in the U.S., you're seeing a lot around the clean tech sector, predominantly because of Biden's bill that passed, which was over 4 years dedicating $2 trillion across both things like batteries, electric vehicles. So a lot of exciting things. We're also seeing that as a consistent trend on the public markets. And then two other ones we're seeing is actually on the robotic space, which in the Midwest, if you think of some of the leading institutions or universities we have here, aside from U of C here, but obviously Carnegie Mellon, which was one of the top robotics universities in the US, you're seeing a lot of momentum there. And then on the blockchain side, aside from just like wallets or cryptocurrencies, which obviously are getting a lot of flair, just given they're tied to the sort of digital investment side, but actually the technology itself and where it can be leveraged. So if you think of the finance space with the whole DeFi movement and using smart contracts, leveraging what Ethereum is building, I think that's super exciting. And I think a lot of folks don't know, but Ethereum was co-founded actually in Canada. So there's definitely a massive movement within blockchain, but the underlying tech, not just the currency side as well.
Understood. That's really exciting. Sergio, what would your thoughts be on that?
Yeah, I think. Well, it talks specifically about the blockchain space. I think with the valuation of Bitcoin, the space is definitely getting hyped. While I think surrounding areas are getting hyped. If I were to narrow it and talk about operational efficiency using decentralized, decentralized databases are going to be integrated, into organizations across the board. And I see them more. I like to tell people, like, we think of them as blockchain companies now, but we don't call companies spreadsheet companies, right? Like it's just a tool that will be integrated into different companies. And it could be used in different ways, and we just don't understand them yet. I think people are getting overly excited about NFTs and alike, but the fundamental movement was about an alternative form of a digital asset, if you will, that's scarce, that is secure, that we could actually be a store of value. And I think that is the primary use case right now. And there will be others as they arise, but that's the primary use case, and industries providing infrastructure around it are the ones that are winning. And we don't talk about that, but that's, you think of the Coinbase, the Chainalysis that just does regulatory. You think of, there's new companies coming in that are doing custody compliance. They don't sound as sexy, but insurance and compliance and infrastructure, at least in that area, is where the investment ready opportunities are. But I'll pause there. So.
No, that's really interesting. Amanda, would love to know your thoughts on sort of the startups that you've seen. What sort of technology trends have they sort of captured on in the recent past?
Yeah, I think recently a lot of what I've been seeing is obviously with just this past year and everything, and just the big digital transformation that has come with that. We're seeing both a lot of companies that are helping businesses manage that, whether it's ways to increase their cybersecurity of themselves and their suppliers. We've had a lot of cybersecurity deals actually coming in lately. Also looking at a lot of just overall how we're approaching the healthcare system, managing that. How you can really be best interacting with patients when they aren't maybe physically coming into the office, managing chronic disease that way. So I think it's a lot of what we've really seen, especially in this past year. It's just how we're becoming more and more digitalized, and the various ways that we've needed to manage that.
Definitely, that's really interesting. There's been a lot of talk recently. I mean, over the past sort of year, so specifically when sort of COVID started to hit, in terms of how investors were sort of approaching the whole COVID dynamic, in terms of the liquidity, in terms of the investment capital that was being put into startups throughout COVID, and then obviously now that it's become it's been a while. So Guy, I would love to know your thoughts on sort of how investors have viewed COVID in terms of investment opportunities, in terms of the startup landscape, in terms of the level of liquidity that investors are leveraging.
Yeah, I mean, I think not unsurprisingly, very surprisingly to many of us, as of where we were thinking things might be heading a year ago, it's 2020 was a very good year for tech and for tech investors. It's a power law game, and so if half of your companies were decelerated 25%, but the other half were accelerated 50 to 75%, you come out way on top in a linear average, but you really come out on top from an exponential balance perspective. And that has happened for many venture investors and for many entrepreneurs. Now, of course, that doesn't take away from the fact that for the entrepreneurs who face the headwinds, who had no revenue growth or step back 25% in revenue, it's really hard and it's not fun. And our hearts and our support go out to them, and we have companies in that position in our portfolio, and of course are working with them to find a way back to growth. But overall, it's been a good year, and there's really never been more liquidity than there is now. You have a massively open IPO window, and everything sort of flows down from that. So you've got excited pre-IPO investors, that creates excited Series C and Series D investors, and that gets early stage investors all worked up. And at the same time, the outcomes are huge. You have decade billion-dollar and multi-decade billion-dollar IPOs are almost becoming the standard type of IPO rather than the single digits. And so that creates a lot higher willingness to pay on the capital side. So overall, it's a pretty rich environment for startup founders and for investors. And we'll see where it goes.
Definitely. That's really interesting, and sort of brings us to the next question. As you mentioned, I mean, a lot of the startups in the recent past, or even now, frankly, have seen a lot of success in terms of the kind of valuations that they've raised at, or the kind of acquisitions, the kind of returns that they've received on their investments or on their startups. And there's been a lot of discussion regarding sort of a valuation bubble in terms of how startups are valued, and depending on growth metrics or some other key factors. So as investors, my question is that what are sort of some primary key investment merits or key investment factors that you look at while making an investment, and how do you possibly justify a valuation in the early stage? So George, would you be interested in taking the question?
Yeah, certainly. It's always an interesting one for the exchange, because we kind of sit in the middle of connecting companies to capital. I do think what we're seeing now, Harshid, is some subsectors are definitely getting more attractive valuations than others. Like the plant-based subsector right now, if you look at some of the companies that are listed, some of their valuations are really, really high. The e-commerce side going through the same thing. Amanda, you mentioned digital health. We're also seeing that transition as well, and just kind of the health consciousness seen even around mental health tech that we're also seeing companies and investors open up to. So I think on the valuation side, just a quick comment there, we're seeing some subsectors get more attention from public investors. I'd say what kind of things we would look at is obviously especially for earlier stories that look to access public markets, I think scrutiny on the founding team is super important. And by scrutiny, I mean obviously their experience within the industry that they're serving. So you never want to see a founding team that's just getting into, let's say, e-commerce, but their whole history has been in mining. And just because e-commerce is getting this massive traction, they're trying to create a win in that sector. We never want to see that as much. I think what's also important is if you don't have seasonality on or maturity on the founding team, you can always supplement or complement that on the board side. So we always look at who's involved on the board. Obviously, the diversity around the board is super important. And then obviously, back to those kind of subsectors that we listed, I think that's also really important. So looking at, are you in a subsector right now that's just getting attention? Is there interest? Again, I would say the last point there is kind of storytelling the strategy is super important. You often hear Andreessen Horowitz talk about this, probably the most important, but also underrated factor that we see commonly with CEOs. And when you look at public versus private markets, it's even more important, because telling the story in an articulated way, in a simple way that the masses can understand, is going to be critical to getting massive adoption early on.
Definitely, that seems really interesting. Sergio, what do you think have been some sort of the key investment merits or factors that investors look at while investing in the early stage?
I think one thing I want to relate to your previous question, and I don't pretend to know the answer as valuations go up and down. I find it a weird time where certain industries are starved. So some valuations seem low, or think of travel, right? Like that's definitely been starved for the past year because of COVID. So a lot of startups that I know, founders ended up closing shop, but now that's going to change and come back. And then at the earlier stages, even with the enactment of crowdfunding, and now you can raise beyond $1 million. You could up to $5 million, and a lot of I would say direct investors that aren't professional investors now can invest at and aren't aware that they're paying really high valuations, like they don't understand because they're not as mature. It's really impacting, like it's really frothy in some areas, in some pockets, and not in others. So I think it's what I'm trying to do, I would say personally, is just double down on a sector so I can own it and understand like what's normal and what's not, rather than be a generalist and play all over. But I mean, that's my strategy. So I think it's an interesting time. I thought there was going to be more of a correction, but with a lot of government funding now trying to like continue to prop up the economy as we're going through this, like coming out of our like stationary workplace, I think that we're not going to stop going up for a little bit. I think maybe that's my hypothesis.
Understood. That's definitely a fair point, and there's definitely a really interesting perspective on it as well. Given like the difference between industries, some industries receiving a valuation bubble versus other industries, as you mentioned, being starved. Amanda, what would your thoughts be on that?
I think kind of as we're looking at a lot of the stuff right now, a lot of what we're kind of in consideration outside of our, normal when we're kind of screening through companies, looking at some of these early factors for, early stage companies. We're looking a lot to it, just the traction. And, is this traction, really just because of COVID, and is it going to be, lasting? Depending on the industry it is in, or, maybe if the traction is lower and this is still potentially a good opportunity. For example, some of the ones we're looking at that are in more the event space and everything. So that's definitely been a new factor that we've, been having to take into consideration, and probably will for the next, at least year or so.
Understood. Well, some of the people, some of our listeners right now have been entrepreneurs or are current founders right now, and they're really interested to know sort of what would the best way be to approach investors? Is it just should it just be cold emailing them? Should it be through some common network, leveraging some common network they have, or through the portfolio companies? So the next question is basically, what are some of the best ways for startups to connect with VCs or sort of be noticed by them while reaching out to them? So Guy, what are your thoughts on that?
Yeah, sure. I think the honest answer is all of the above. So, of course, if you have a means to get a warm intro, you should take advantage of that. But that shouldn't stop you from cold outreach. The other thing I would say is in this virtual environment, and especially in a world where there's increased interest and focus on finding diverse teams to invest in, whether you're a diverse team or not, it's created a lot more matching type of events where whether it's a venture firm will sponsor it or an accelerator will sponsor it, events where companies are being matched or investors are being matched with startups and vice versa. So it's a double opt-in. And I mean, just in like the last month, there's been 3 or 4 in the Midwest, or the last month and the next month, there's 3 or 4 in the Midwest. And actually, they've proven to be very helpful on both sides, I think. And so if you're an entrepreneur, keep your ears out for those types of opportunities.
Understood. That's reasonable. So bouncing off that, sort of concluding the Q&A session, a lot of people are really confused about what sort of ideal path to follow to become a VC investor or to get into venture capital. So George, what would your thoughts be on the ideal path? Sort of what sort of take to get into the VC world?
Yeah, certainly, and just maybe just a quick touch point to what Guy was saying, just in terms of the other question. I would say from even the founders that I've talked to or had on the podcast, like one in particular, Gary from Replay, he's actually going to be speaking at Startup Grind tomorrow for anyone in Chicago or virtually looking to attend. But he basically said like one of the biggest tenets was always learning from other founders who have raised successfully. The other one I would say a really good podcast to check out is Masters of Scale. There's one particularly with Kara Golden. And she basically talks about leveraging the no's. So for every like 200 no's you're going to get, to a ratio of, let's say, 1 yes, there's a lot of gems in those no's that you can actually leverage and pivot the strategy. And then the final one from Sarah Blakely, actually, I just read on LinkedIn, it's be creative. So she actually, in one of the meetings, she actually sent a physical shoe to one of the VCs and, like, quote unquote, I got my foot in the door. So anyway, I think being physically creative, I think is sometimes important. To the question around, cracking the VC space, I think it's important to, right off the bat in university, kind of leveraging those tools as well. Like being persistent, I think is important. Going to some of those meetups, really making yourself present. I think what I didn't know, certainly coming out of uni, was knowing how close of a tight-knit bubble or community the startup ecosystem is. Whether you're in Chicago, NYC, Cali, Toronto, they're all, I mean, once you're in it, you really feel how close it is, even though sometimes it might seem large and intimidating from the outside. So I think making yourself present, building a brand really around value as well, even as a student. I don't think you need a title or kind of a seniority to wait to figure out how to be of value. And you actually can see repeat examples of that, whether it's making a connection or brainstorming with someone, coming up with ideas for a startup you really want to get involved with, or a VC fund that you really want to work for. I think just kind of positioning yourself as being of value and differentiating yourself early is going to be super important. And then also, the last thing I would say is don't discount the fact that you can get into VC later, right? You often hear like getting into PE might be a bit more difficult because it's a bit tighter of a space to crack into early, but maybe going the startup route first and then juggling back into VC, going into iBanking first, going to consult. Like there's different routes that you can create a lot of experience, a lot of value within your repertoire that you can then leverage when you get into the VC world, specifically if one of your assets is building a network and you have a big pipeline of startups that you've been able to connect with.
Understood. Sergio, your thoughts on that?
Yeah, I would say the whole reason Rebel One started was to increase access to this knowledge. I would say for me, I went to consulting, then I went to grad school, went to Harvard Business School. I came out and then I cut my teeth as a founder. Things exploded. Ended up working in venture, and like and to get the experience to be in venture capital, I had to work for free for a period of time. Like it's absurd. It's like the amount of like time it took to do that. And so we created like a training program that some people pay for, and I'm actually engaged at the University of Chicago to do some of that training for students. But I would also say to students that are they're like, oh, I'm trying to get into venture capital. There's very few jobs. There's just as many jobs as there are jobs to be a professional athlete, like to put that into perspective. So it's just like insanely competitive, and it's not always merit. It's like merit plus lots of luck, lots plus connections that are unfair, and that's just the way it is. So I actually think people should more become founders and go in, and you can still, this is what I say to people too. I was like, you could work at a tech company, make great money, probably more money than you would in venture capital. You could take some of that money and directly invest and build your own track record over time so that when you do want to raise, you have your own track record. So I think that there's a bunch of ways. You just have to, hack your way there like a true entrepreneur. But I'm happy to chat more about it, and I'll drop a link in on breaking into venture. So.
Definitely, that's very interesting thoughts. Amanda, just your concluding thoughts on that before we move to the listeners' Q&A.
So, as I mentioned earlier, with my experience, I had started my own company 7 years ago. And, while that was more of a kind of Midwest-based small business, not exactly a startup in that sense, it did give me some of that operator experience, definitely, and, experience in space. And then kind of as for myself working into VC, if for people at University of Chicago or schools, a similar program, I'm right now doing a 1+ year program as a associate M25 through the PEVC lab. And so I think that's a great program to be able to get that experience, be able to, start to make a pivot into venture capital if you haven't worked in that area before. And also taking advantage of the other ways, as, mentioned, to kind of, have experience with startup, whether that's founding your own company or trying to just be a founding team member in another company. Definitely agree with that too.
Definitely, that's really interesting. Would love to hear any last-minute thoughts or concluding thoughts that the panel might have before we move to the Q&A for the audience. Well, great. For the audience or the listeners, it'd be really helpful if you guys could um, type in the chat all the questions that you might have for the panel, and then I can ask them right away.
Just dropped the link also. I didn't see any questions, but I dropped the link into an article I wrote on LinkedIn, a little bit on how to break in. It's great if you start as a student, like Amanda. M25 is awesome.
Well, I guess till the time we get any questions from the audience. Oh wait, I think we have a question. So Joseph mentioned seed versus Series A. What are the expectations on the revenue? Guy, do you want to answer that question?
Sure. That is constantly changing. I would say most seed stage companies have the median is probably 0, and the average is probably $50,000 to $75,000 in ARR. So companies that are raising a seed stage round generally have very little on revenue. They often have users, whether it's direct to consumer or whether it's early pilots on the B2B side, but very rarely a lot of revenue. And then Series A, it feels like the range has become tighter and tighter between seed and Series A. There used to be something called post-seed in between. Well, first there wasn't, and then there was, and now that feels like it's mostly gone. Really anything with about $1 million of revenue, sometimes even $500,000, is really a Series A type of opportunity. And that's quite a bit lower than it used to be. It used to be 1.5 to 2 million for a really solid Series A.
Understood. So Ricky has a question saying how to look for funding for a person who just graduated from university. Maybe Amanda, given your experience, you might be able to answer that question well.
Definitely. So I think one of the things that we look for, with people who are, recent grads, is to try to still have, diversity in your team, and not, even just diversity of, the gender or, race of your team members, but also looking at just, the experience of your team members. Like, if you have a group of all MBA students, you're not getting that full diversity of experience. Trying to bring in someone who's a more technically experienced co-founder, or someone who has more industry experience, that's definitely really helpful for your team to try to balance it out that way. And also balance it out with your board members. I think another great resource is to really, lean on wherever you graduated from that network. We have a lot of incoming deals that we see, through various schools, through, we get a lot from the University of Pittsburgh, a lot of the Michigan tech transfers, a lot of schools coming in with that incoming deal flow.
Definitely makes sense. So Brian has a question. Any funding opportunities anyone knows about? I think I would pivot that to ask a question about sourcing, maybe. So George, probably the question for you, sort of pivoting off of what Brian's asking. What are some of the best sourcing techniques for VC investors, like when source startups to invest in or to connect with?
Yes, and I just want to clarify that question. Is it basically how to get their attention, or where to find VC? Is that where it's going? Just want to make sure I answer that properly.
I believe so. Yeah, I think so. Maybe, not sure.
Okay, hopefully I'll answer. If not, Brian, make sure to let us know. But in terms of sourcing, as I said, I think what's usually under leveraged is LinkedIn in the right way. I think being mindful in terms of connecting. You have to remember that from a VC perspective, like they're getting. Yes. Okay. Perfect. They're getting hundreds of different connection requests, different emails, and sometimes like the standard template, hey, I want to connect, would love for you to check out the deck, isn't necessarily enough to get someone's reception. And think of it in reverse. Like, what if you were in that person's shoes? Would this be an email that you would be excited about, or a DM or a request, whatever it is? And I think sometimes getting creative in terms of the approach as well. Like I always give the analogy of building the relationship first versus going in with the ask. So on LinkedIn, as an example, if that's kind of your medium of choice, connecting with some of the VCs that are or have invested in the space that you're trying to tend to, but also engage with their posts. If you see something similar of an investment that they made, maybe comment on that first, build up that, I guess, relationship, and then maybe send them a message, say, listen, I've been connected for a while, or send them a post of something that they shared and say, we're kind of in that vicinity. Would love to just 10 minutes of a quick call to brainstorm where we're at and where we're heading, and would love to get your thoughts on it. So I just think developing the relationship is usually undervalued versus going straight with the ask. Last thing I'd say is always be mindful of raising. Like, you hear this often, but you really always have to be on when it comes to thinking about potential investors. Again, whether going to events, speaking on panels, getting yourself out there, I think is super important. And don't discount that it's always better to have those relationships in place before you look to raise, versus when you're now looking to raise a Series A and no connections are in place. It's just going to make it much harder.
Understood. I think that sort of answers the question. Enka, we have a question for Enka. She says, for new grads looking to be founders, part of a founding team, would you prefer having them go into big tech first, or to gain experience, or go into startups right away? So Sergio, I think you mentioned about this a bit, but would love to know your thoughts on this.
I mean, I think it can go either way. I think when when you're looking at a startup, I mean, I think for me, like, as Guy mentioned before, active users, I tell founders all the time, active users and paying customers cure all ills. Like, I know a founder right now, he's been talking to me for several months. He hasn't launched his product. He's a professional. He's graduated a long time ago. He's seasoned in product management. But I was like, dude, like, just put something into the planet. Like, I can't, like, the investors I'm syndicating with aren't, like, that's not what they back. Like, and everybody's different, right? I think if you, it's just very risky, right? Versus you could be a student with a product that you have a lot of users and you have some revenue, and that's actually more attractive. So it doesn't, where you would think it was the other way around, right? Like, they should get some experience. So I think it's a matter of the stage of the startup versus, like, where the founder's coming from. But
Understood. Moving on to the next question. So Seth has a question. He says, when I think of investing and pitching, I think of Shark Tank. So how has the show sort of affected perspectives or investment, for better or for worse? So George, do you want to take that question?
Yeah, sure. I guess a couple of thoughts on this. The first part is, I've had a couple of friends, and I know this is not indicative of everything, because I know we have a recent case in Chicago with, I believe it's called Quavo, if I'm not mistaken. They just raised from the founder of Kind Bars, so it does work, in some cases. In other cases, I have had friends who say, they've pitched on the show, it was great for marketing and exposure, but to be frank, once, like, the post television, like, they cut off the TV, the conversations kind of went sideways. There wasn't follow up on due diligence and stuff like that. So from a marketing perspective, especially if you have a product that's very consumer brand focused, like Quavo in this case, I think there is a lot of benefit to that, especially if it goes well and you don't necessarily embarrass yourself, hopefully not, and you're prepared, and maybe, it's a yes, quote unquote. I think that might be interesting, but just know that it's more, I would say, exposure and flair versus, like, the actual way to invest, whether through a proper seed round or more of an institutional investor. Just something to think about.
Understood. Amanda, bouncing that off of you, what would your thoughts be on that?
Yeah, I think I just pretty much have some similar views there as well. I mean, obviously, it can help in some cases with the marketing side, but, it's, being able to see a name like Mark Cuban, is invested in this, it's more of kind of a vanity, than it is really kind of real data into, the company itself.
Understood. Reasonable. So the next question we have from Rob. Would you share your views on...
Actually, can I jump in on that one real quick? I think,
yeah.
Sorry to go out of sequence here. I very much agree with what George and Amanda said. I would also point out that, Shark Tank is theater, and for the youngest generations who are now moving into adulthood, I think and for everyone now who lives so much of their life on a screen like this, and virtually on Twitter and all that stuff, it's like more and more of our lives have become theater, and you got to know the difference. Which is not to say that this
so good
right
so
now
true.
is not theater. This, in fact, is theater. So you just have to know the difference. And in reality, building relationships is what matters the most in finding a good investor and finding a great entrepreneur to work with on the other side of the table. And so that's certainly what we try to focus on. And I would say the entrepreneurs that we like to back do the same.
I love what Guy said. I'm gonna go like I always like understanding. It's like, who are the players and what are the incentives, right? So Shark Tank is just really interesting. If you look at the players, right, it's like a set of people that they're investors, right? The founders come in and people don't realize they give a chunk of their company up, whether they get an investment or not, to the show. So the incentive really is to get the marketing and eyeballs. That's it. There is little to no incentive actually to do a deal, to take that deal, for the terms. It's just that really the founders win when they get on the show and they get on camera and they're blasted all over. So it's just understanding that's not really investing and understanding or those may not be the best investments, right? There's a couple of different things to think about. So it's understanding the players and why they're incented. I have a whole opinion on crowdfunding and what those platforms are incented to do as well. And sometimes accelerators, incubators, right? Jacking up valuations right after they demo day, almost in a way that doesn't make sense. So there's a lot of things to consider as you become a venture capitalist, or even become a seasoned angel investor. So.
Definitely. So as you're holding on to that thought, the next question that Rob has, it also talks about how maybe talking about Shark Tank or otherwise, how would an investor respond to a valuation discussion? Supposing that if a particular founder feels the valuation of a company should be completely different compared to what an investor feels. So how would you respond to founders who have a different valuation calculation than you feel is reasonable, but a solid MVP?
Yeah. So, it depends on the maturity of the startup, right? So I think common mistakes I see. Really green founders come in and they're like, I projected my revenue is going to be X in a year or two, so my valuation should be all the way up here, right? The evaluating your company off projections is when you have 2 to 3 years historical makes sense, not when you don't have any customers. But there are norms in the space, right? For early stage startups that are at the, I say, accelerator phase or pilot phase. If you look at, they're taking 5% to 7% for, $100,000. So that's you think of the floor for a set of companies. And then you have, people coming out of Y Combinator that are raising between 8 and 12, which is high, for where they are. But, and you have everyone in between. So you just have to, it depends on the investor. And what the market demands and your industry, and there's a lot of factors at play. But I'm sure others can speak more.
The only thing I'd add there is, especially on the public markets, is usually having comps, right, or comparables. So on the public markets, at least you can. It's tough to justify something that's extremely out of the norm when a couple of similar or comparable players are trading at X valuation, right? So, and that's what investors usually are going off of anyways. So I think that's super important to Sergio's point. And, especially, I think certain things might give certain startups a premium. So for instance, if you've had very successful exits in the past, whether through M&A or IPO, and you have this really, really successful, strong reputation, you might get away, especially on the earlier side, to get a bit of a premium. But these are outliers. I think for the majority, it's understanding your space really well. And one thing I'd really encourage is specifically for things like the total addressable market. I think sometimes you'll put that on a slide deck, and you'll kind of put out a stat of the total market, not necessarily what percentage of the market you are capturing today. Those are two very, very different things, or maybe let's say 1 or 3 years down the line. And the last thing I'd say, being on the M&A side as well, what ends up happening is when you're raising these, like, I guess, seed to Series A or B rounds, you're usually raising at a growth multiple. But those growth multiples tend to be different than exit multiples. And sometimes if you raise without necessarily thinking of what the implications might be, if you're doing so at a valuation that you're not necessarily comfortable with, same thing happens on the public markets. If you launch at a very high valuation, we saw that with Twitter's IPO. Maybe it's rebounded, but I think if you look at the start, it was a bit rocky. So just think about what implications you're doing today that might lead to maybe a more negative consequence down the line when you look at exiting or maybe potentially IPOing.
Definitely. Guy, your thoughts on that? I think you're muted.
Right. Yeah. Can you repeat the question just to make sure I'm concise about it?
Oh, yeah, definitely. So how would you respond to founders who have a different valuation calculation?
Yeah. I mean, I just tell them how we look at it. I think it was George or Sergio who said you gotta think about the shoe that the other person's wearing, and we try to help entrepreneurs do that, and vice versa. So I'll basically say, look, you want a $20 million pre-money with a $5 million raise. That represents 20% dilution. I think I'm doing the math right. That's way at the low end of dilution that we see for anything but a tiny seed round. So that there may be investors who are open to that. There may not be. You'll find out. But our concern is the post money is 25, and you have $250,000 of revenue, and we define success as being our best companies get at least a 2x uptick, if not a 3x uptick to the next round, which means that you're talking about a $75 million pre-money. And the plan that you showed me tells me that you're planning to end next year with only $1.5 million of revenue. So I don't believe that you're going to raise your next round with 25 on 75. And that's what I would have to believe in order for me to want to invest at a 25 post now. And so then the conversation goes from there. And people usually understand that. I mean, I've actually had very, very few entrepreneurs who, once you explain that logic, push back heavily, other than to say, okay, but others might pay more. And I say, well, absolutely. Like, you should be talking to other folks and you'll find out if they will pay more. That was a lot of math. Hopefully everyone.
No, that was it. That was a great example. So it's a perfect logic.
Yeah, I think that was a well reasoned or well thought out answer. So that did probably answer the question. Joseph has a question. Any thoughts on no-code startups? Does the underlying tech matter in getting funding? So Amanda, what your thoughts on that?
I'm sorry. Could you? I want to make sure I properly understand. Could you repeat that?
Yeah, sure. So Joseph has a question regarding any thoughts on no-code startups. So does the underlying sort of tech matter in getting funding, and how would investors view that?
Yeah, I'm going to definitely, let one of the other people on the panel kind of answer that. That's not something I've had as much experience in personally.
Sergio, your thoughts on that?
I think you have to think about, because there's a few there's one that we just looked at as because we like marketplaces. One, what's the alternative if their platform is pulled from them? If it is custom, right, and they're using someone else's custom code, it may stop working or something. And we actually just hit this. But if, let's say, have what de-risks that? Well, do they have just a lot of users and a lot of customers and they're making money and it's growing? It's like, okay, then they could probably hire someone to create an alternative, or are there alternatives? Like right now with Stripe, you can simulate or prototype if that platform they had didn't work. So we're still nervous, it's a risk, right, factor, but I think you look at what is the strength of their network if it's a no code, and then what are alternatives if that whatever they're using doesn't work anymore, so you could de-risk your investment. That's the short answer.
Understood. George, you want to hop on that?
Yeah, I just, I think it was Joseph. Yeah, Joseph. I just shared, one of the podcasts I did actually with the CTO and co-founder of a company called Acern out of New York. He basically kind of talks about it in a much more technical manner because he's obviously much more versed in that space. But Acern basically accelerates the AI workflow for enterprises, specifically within finance. So they work with the technical teams within, whether it's different banks like Jefferies or even firms like IBM as an example. I think for the funding question, maybe the best thing to do is if some of these firms are your clients potentially, that's the best way to maybe get in the door. So when I was working for a fintech startup called Owl.co, that's kind of one of the best ways we I guess positioned ourselves for funding. We would go to the large banks. Allianz Ventures was one of the investors within the space, and that's because we were able to work on a pilot. Right, or if you're targeting one of the big banks, maybe work on something on a smaller scale, and then work upwards. It's sometimes, I think, difficult with no-code environments because specifically with regulated environments like, let's say, the financial space, you would think that they have big checkbooks and they would deploy them quickly, but it's often the other way around. I mean, they have big checkbooks for sure, but it always took us much longer to build their comfort around the risk appetite, getting on the preferred vendor list. These things are going to take time, but I think the best way to do that is work on something small, display value, and then work upwards.
Definitely, that's really interesting. So sort of the last question before we wrap up, one from my end, any sort of key hacks or tips you would have for or startup founders or people looking to get into VC investing or startup founders, any sort of one tip or key hack that you would sort of provide them with? Guy, you want to start with that?
Yeah, I mean, honestly, I think for anybody who can afford to bootstrapping for as long as you can is a really good thing to do. And that's going to be a very different amount of expense and amount of time for people of different means. And that's just a reality. But I think taking capital too early is option reducing and is nice to avoid. I say that as a seed investor.
Interesting. Amanda.
Yeah, I think just kind of a lot of the similar thoughts there. We also do a lot of the pre-seed and seed investing, so a lot of kind of similar same thesis.
Interesting. George.
The only last thing I would say is definitely know all your options, whether that's fundraising or otherwise. Know them now, like basically start today. And whether you're positioning your startup for a seed, a series A, a B, the public route, the acquisition route, everything you do today and moving forward is what's going to lead to that. So it's always better to know how to manage your finances with $10,000 in the bank versus 10 million. Right? Everybody wants to win the lottery, but nobody wants to spend the time learning what to do with it if you win. So.
And Sergio, to wrap that up.
Yeah, I would say one thing I learned the hard way. I think most founders don't have extended access to capital, so focusing on active users and paying customers should be your priority. If you do have access to capital, then that affords you to take certain risks to build startups that maybe cash isn't a concern for the next. You could spend 6 months building because you're afforded that, but know that that the amount of risk you take should be proportional to the amount of capital you can get access to realistically. So.
Definitely, that's really exciting, and that sort of wraps up our panel. Thank you so much to all the panelists, and it was a pleasure hosting this event with you all. Also, thank you everyone for attending the event. We would love you to share your feedback for the event on your Instagram stories or other social media platforms. So please do this by tagging @Chicago Startup Week to let us know your thoughts. For the audience members, I encourage you to head over to our next event, Young, Scrappy, and Hungry, Harnessing Chicago's Top Resources. In order to get there, just click session on the left hand and see you there.
Thanks, Harshit.
Thanks a lot, all the panelists. It was really great speaking with you and hosting you today.
Thanks all. Appreciate you. Stay well. Take care.